Hello, my name is Taylor Lapidus. I'm with The Precision Team, Keller Williams Arizona Realty. Thank you very much for taking the time to watch our vlog. Today we're talking about proposed new legislation that would amend the Truth in Lending Act and try to do away with conflicts of interest between loan servicers and the investors that are holding the note on the property. So when you have a mortgage or a deed of trust, you owe someone money for that property. You borrowed so that you could buy the home. They gave cash so that you could pay off the seller and you could move into the home. And now you're paying back that lender. Well, you may be making your payments to a servicer who's just representing the person that actually is the investor that gave the money. The servicer is paid to take care of any issues if you miss your payment, making sure that you're making your payment on time, late fees, and all these little details. It's just easier to give it to them. They do it a lot, like Bank of America. It's a huge bank. They service a lot of loans for other investors. What happens if the homeowner wants to do a short sale? In short sales, second loans, they get practically nothing. I mean, if your second note, if you have an 80-20, let's say, where 80% is your primary, your first lien position, the bulk of the loan, and 20% is the second, well, if they're holding the second note, let's just say for round numbers, it's a $200,000 property. $160,000 in the first, $40,000 in the second. If you're going to short sale that property, let's say the home is worth $150,000, you can see that the $150,000 isn't making the first whole. There isn't even enough to pay that off, let alone all the fees and things that go with it. So in representing this investor, the servicer, looking at the short sale, would then potentially look at their second lien position on that 20% note and say, well, wait a minute, if we let the short sale go through, we get zero, or maybe a couple $1,000s if the first agrees to kick it over, or maybe they'll shift how much the first agrees to kick over because they're the servicer. They get to make these decisions or recommendations on behalf of the investor. You can see how this is potentially a major conflict of interest. So the question is, should this legislation be put forth? Should they finish putting it together, investigate it further? Are these good concepts? I wonder how often these different departments are really talking with each other. Having dealt with banks on these short sales and on bank-owned properties, REO sales, the left hand does not know what the right hand is doing. So it's not exactly intuitive to think that directly the servicer may be looking out for their potential interests on the second. They don't even know when a foreclosure is coming through because that's a different part than the short sale people, which is different than the loan mod people, which is different than, so forth and so on. It's all different divisions of a major monster that don't talk to each other very efficiently. Hopefully that's going to improve. Hopefully they will start talking to each other more efficiently. And thanks to computer technology and digital files, that really should be easier than they've made it. But for whatever reason, they haven't gotten there yet. What do you think? Do you think this legislation is important? Is it maybe preemptive to the potential of them getting to the point where they are communicating well within all these departments? Do you think that there's potential that a big bank who holds a second and is servicing the loan for a different investor is potentially going to do something shady so that they can come out ahead on that second note? We'd love to hear your opinion. Leave a comment below or email us at myopinion@theprecisionteam.com. Thank you very much for your time. My name is Taylor Lapidus. We're The Precision Team. Have a fantastic day.